Here is the overview of today's gold market news. Price trends, technical analysis, and future projections. Rate cut and economic context. Market reaction and investor sentiment. Speculative positioning and potential pullback. Let's have a look at the recent price trends, technical analysis, and future projections. Gold has surged past $2,605, reaching a new peak record high of $2,626, continuing its bullish trend. The next price target zone for gold extends from $2,650 to $2,661, with potential upward movement towards $2,724. Gold's advance was marked by a significant breakout above $2,605, indicating strong bullish momentum. After a poor close on Wednesday, today's rally confirms a reversal, overcoming previous bearish signals. Gold has been on a consistent upward trajectory since breaking out of a multi-year basing pattern in March, characterized by higher monthly highs and lows. Key support levels for gold are at $2,600 and $2,570. A significant upside target is $2,700, though overbought conditions may limit further immediate gains. The near-term technical analysis outlook indicates that gold is approaching overbought levels, with the relative strength index hitting 70. A potential correction is anticipated if it exceeds resistance at $2,630. Gold's initial rally to $2,600 follows the Federal Reserve's unexpected 50 basis point rate cut, but reversed to close down 0.5% at $2,555. This lackluster reaction was surprising given the dovish nature of the Federal Reserve announcement. Prior to the Federal Reserve meeting, traders anticipated significant gold gains, driven by expectations of multiple future rate cuts. However, speculator positioning in gold futures was already overextended, limiting further buying. The recent price action reflects accelerating momentum, distancing from its 20-day moving average and suggesting a strong upward trend. Analysts project future gains, with the next notable target at $2,724, corresponding to significant retracement levels from previous declines. Here is the update on the Federal Reserve rate cuts and the economic context. Federal Reserve Chairman Jerome Powell announced a half-point rate cut, which was unexpected by most Wall Street analysts who predicted a quarter-point cut. Powell characterized the rate cut as a positive move aimed at sustaining economic strength, highlighting cooling inflation and a robust labor market. Michael Farrelly from J.P. Morgan, who had forecasted the larger cut, emphasized the need for the Federal Reserve to adjust rates sooner rather than later. Despite the rate cut, inflation remains elevated at 3.2% annually, above the Federal Reserve target of 2%. Many market observers question the justification for such a large cut in light of stable economic indicators. Central bankers will meet again on November 6 to 7, with Farrelly predicting another half-point cut. As the Federal Reserve enters a blackout period, upcoming comments from policymakers will be scrutinized for insights and guidance on future rate cuts. Currently, market anticipate a 70% chance of additional rate cuts in 2024. Moving on, here are the latest market reactions and investor sentiments. Gold to US dollar exchange surged to a record high above $2,600 due to significant selling pressure on the US dollar following the Federal Reserve's decision to cut the policy rate by 50 basis points. Initially, after the Federal Reserve announcement, gold rallied as the market reacted to a perceived dovish stance. However, the US dollar experienced a brief recovery later, causing gold to retract and close lower. Following the reassurances from Powell on the economy and job market, market risk sentiment improved, which initially supported gold prices. Let's have a look at the speculative positionings and potential pullbacks. Prior to the Federal Reserve meeting, speculative long positions in gold futures were at risk of a pullback due to their extreme levels. This positioning exposed the market to selling pressure, especially if the Federal Reserve was less dovish than expected. Analysts warn that a potential pullback in gold prices could occur as speculative positioning normalizes. A correction of 6% to 9% could bring gold down to the $2,350 to $2,425 range, although this would still be historically high. While the current environment poses risks for a short-term decline, many believe that ongoing rate cuts will ultimately be bullish for gold in the long run. Traders remain cautious and prepared for potential volatility. Amidst a potential pullback, opportunities in gold mining stocks may arise, as they typically outperform gold itself during upward trends.